Let me give it to you straight. Buying a house in 2025 is a financial disaster for most Americans now. Rates are 6 to 7% still. Home prices are still climbing up and up and up. And now tariffs could push cost even higher and higher. If you are thinking about buying, selling, or even sitting still, what you do next matters more than ever. The housing affordability has been low, and now with the higher prices, higher interest rate, higher material costs due to the tariffs, affordability is even getting tougher and tougher. Most people are sleepwalking straight into a housing crisis, and they don't even know it. So the question is, are you better off renting or are you better off buying? Let's take a look at it. Starting with the true cost of buying today in 2025. As I mentioned earlier, rates have been near 7% and they are not dropping. They're still hovering around 7%, 6.5, 6.25. Home prices have been going up and up and up and up. And because the inventory is low, they may still stay up. There is no sign of a recession coming up. But let's see what the tariffs does in the next year or 2 years. Not to mention, when you buy a property or when you own a house, you have to pay for the property taxes, and depending on what state you are in, especially states like Texas and Florida, property taxes are skyrocketing. Then you have to pay insurance, which is mandatory if you get a loan, and those are skyrocketing. In California, in Orange County where I'm at, a lot of the insurance rates have doubled, tripled, or quadrupled. So be prepared. If you buy something with a homeowners association, those are going up. So buying a house today could be a trap. So be careful how you tread to buy a house. Get expert advice before you buy or pull the trigger to buy a house. Keep in mind also that once you buy a house, you will have to keep up with the maintenance and upgrades of a house. And that'll give you extra burden of keeping up your house. Something will go wrong. Your roof may leak, your dishwasher may break, there may be a leak in the shower. So these are additional costs. And with the accelerating prices of everything, because of the tariffs and in general price increases, the house will cost you more than what the lenders actually approve for, because they don't take these expenses into consideration. But we as realtors recommend to the buyers that if your payment is $3,000 a month, for example, keep in mind you'll have additional expenses like repairs and maintenance, and also keeping money extra to put away for your retirement or emergency funds. So let's talk about section number 2, which is budget rules that still work. So if you're thinking about buying, and let's say your cost of rental that you're paying right now is $3,000 a month, what amount of home can you buy? Well, that's when you talk to a lender. But the general rule of thumb is that your payments should not exceed about 1/3 of your gross income. In other words, if you have a mortgage payment of, let's say, $3,000 a month, then your income should be around $9,000 a month. Of course, these are all variables. It all depends on the interest rates, how much down you put down, what your FICO score is, because the terms and conditions change. But this is just a general rule of thumb. And there is a 30-33 rule, which is spend about 30% on your housing payments, save 30%, which is 20% for the down and 10% for maintenance and emergency funds. And then don't buy a house that is more than 3 times your income. In other words, if your income is, let's say, $100,000, then you want to buy a house worth about $300,000 or less. But this just gives you an idea of what you may think of a house that you can afford. But the best way to find out is talk to a realtor or a lender. And if you need a referral to a lender or a realtor in your local neighborhood, I have a national network of the top 20% of the agents. Feel free to direct message me, and there's a link in the description and in the comment section. Please look it up. Let's look at some examples of how the payments work out. Let's assume that you are putting 20% down and the interest rate is 7% fixed for 30 years. So if you buy a house worth $500,000, your income should be approximately $138,000 per year, and your principal, interest, tax, and insurance payments will be $3,200 a month. If you buy a $750,000 house, your income should be around $212,000 per year, and your principal, interest, tax, insurance payment will come out to about $4,800 a month. And on $1 million home, you should have an income of almost $275,000. Your principal, interest, tax, insurance will be about $6,400 a month, just to give you an idea. Let's talk about the tariffs that just hit us this year, and it hit us in a big way. Trump administration raised the tariff globally, and the stock market actually crashed for a couple of days, and the consumer confidence has been crushed in a big way. A lot of cancellations of escrow happened. A lot of people who were going to buy are now holding off. So, as I mentioned earlier, home prices are already high, interest rates are already high, cost of goods is already high, but with the tariffs, it's going to accelerate all those costs. Home prices, especially new home construction, is going to jump significantly for sure. If you buy a house, your maintenance cost is going to go higher. If you're thinking about selling your home, or if the seller is thinking about selling his house, it's going to cost him more to update the house or bring back the house up to par. So when he sells it, he's going to charge you as a buyer a little bit more because it just cost him more. So the tariffs is going to cause some havoc. It has already done so. From this chart, you can see that there are 6 things that could get more expensive for Americans under Trump tariffs. And one thing is for sure is the housing, guaranteed.
The last time US tariffs were this high was in the 1930s, and it didn't end well, deepening the Great Depression. Of course, this time we don't know how long these tariffs will last or how other countries will react. Will they fire back with duties of their own or try to cut a deal?
Trump's proposed tariffs on goods from China and elsewhere could raise the cost on lumber, steel, appliances, plumbing, and your heating and air conditioning, just to give you an example. Increase cost of building and remodeling homes by 10 to 20%. The cost of building a home has already skyrocketed, and builders are having second thoughts or maybe revamping their cost to charge to buyers. This hits homeowners, sellers, and investors across the board. So the big question is, if you are thinking of buying, should I buy now or should I keep renting? In most markets, renting is still cheaper than buying a home and maintaining it. Renting offers flexibility, there's no maintenance, and there are lower monthly costs when it comes to renting. You pay the rent and you're done. No fixing or no upgrading or no other cost other than just paying your bills and utilities. As this chart shows, and I won't talk much about it, but renting a home could be cheaper. Your scenario may be different. One thing is for sure, cost of buying a home in the US has gone up. The Federal Reserve Bank of St. Louis put the national average sales price of homes at $501,000 as of Q3 in 2024. In comparison, the average sales price of homes sold in the country was $498,000 a year prior. That's a $2,800 difference, which means that while the housing market has its ups and downs, home prices tend to rise over time. The same can be said for most rental markets, but the difference is that homeownership comes with more cost than rent. So you have to decide for yourself, are you better off renting or are you prepared buying a house at today's price and today's interest rate, and you will be able to maintain it as you go along. So the best rule of thumb is, if you're not quite ready to buy and you have already talked to a lender and a realtor and you are really stretching, you may just want to wait and collect more down payment, save more money, cut more expenses, and be real prepared. So when the market goes down, and it will go down, the question is, we don't know when, but you buy when you are ready, willing, and able to buy. Don't stretch, and you always buy below your means, because if you buy above your means and all these prices go up, insurance, taxes, repair, maintenance, you may be in a pickle down the road, and that's the last thing you want to be in. The best rule of thumb in 2025 and beyond, if I was asked that question, should I buy or rent, I would say that if you qualify, if you are ready, if you are willing to buy and you are motivated to buy a house, then do so, but be prepared to stay in the house for 7, 8, 9, 10 years at least. And if you're thinking about moving in 2 or 3 years or within the next 5 years, I would hold off and not buy unless I'm going to stay there for at least 10 years or more, because the market could go down. Then you will be stuck by not being able to sell when the prices go down. So buy only for long term in this market. So in this section 5, let's talk about what the lenders require should you decide to buy a house or should you decide to get qualified, one of the first things the lenders look at when you're buying a house is your debt to income ratio. If you look at this chart, a percentage that displays your financial health to lenders is what debt to income ratio is. So what they do is they take your monthly debt, divide that by monthly pre-tax income, multiply that by 100, and they'll give you a debt to income ratio. And they want it to be around 35%, but it could be as high as 40 to 45%, up to 50%, depending on what type of loan you have, what kind of mortgage rates or your FICO score is, and other terms and conditions. But this is just to give you a reference point. What is a good debt to income ratio? Most lenders will accept a DTI ratio of 43% or less. However, it's helpful to understand how different ranges can impact your chance of approval when applying for a mortgage. The more you put down, the less your debt is. That means if you're buying a house and you put 10% down on a $400,000 house, your debt to income ratio will be higher versus if you're buying a house for $400,000 and you're putting 25% down, and if your interest rates lowers it, that'll make your debt to income ratio better. So the factors that affect your debt to income ratio are several. One is your down payment. In other words, how much is your loan? What are the interest rates? And what are your total monthly payments or expenses? So let's look at it further. I'll show you an example here. Let's say you earn $6,000 a month before taxes and you have the following monthly payments. Just as an example, your mortgage loan is going to be about $1,600 a month. Your auto loan that you have could be 2 cars, but your total auto loan is $500 a month. Let's assume you have a student loan and you're paying $350 a month. And then let's assume you have a lot of credit cards and your payments are showing up on average $400 a month. So how do you calculate the debt to income ratio? Well, your total monthly debt, if you add them all up, is $2,850. And if your gross monthly income is $6,000, then your debt to income ratio, it comes out at 47.5%, which is very high. So if you increase your down payment or if you get a loan, adjustable rate loan or other loans, then you can reduce your debt to income ratio. So the bottom line is figuring out your DTI, debt to income ratio, can help you decide if now is a good time to buy a home or should you wait. If your DTI ratio is high, waiting may be a better option. However, if your ratio is low, you can take advantage of your proven ability to manage debt and apply for a home loan. So whether you're thinking of buying now or waiting, one of the things you have to keep in mind that it's not what you qualify for, but it's what you feel comfortable about paying every month. And remember that even though the lender may qualify you for, let's say, $3,300 a month, doesn't mean you can afford it, because they do not factor other costs. Let's say you have parents staying in the house and you're taking care of them, or you have kids and you have extra expenses, or you have other expenses that they don't ask for. They don't take that into consideration. You may have high utility bills, you may have high TV bills or internet bills, anything else that cuts into your debt to income ratio, which the lender does not check. So just because your lender says, hey, you can buy a house up to $400,000, doesn't mean you can buy that. You may have to buy lower than what it shows on paper because there are other factors. And once you buy a house and let's your medical insurance payments go up, or your kids' school, if they're going to kindergarten school or if they're in private school, those costs go up. That stretches into your monthly payments. So you have to carefully think about what your current payments are and what are your potential future payments are before you jump in. Because as I mentioned earlier, if you were to buy a house today, I would stay in it for at least 10 years just in case the market drops. So in the meantime, if everything goes up, will you be able to pay those extra costs on top of your mortgage payments? So be careful how you buy. I always recommend that you buy below your means, especially now in 2025 and beyond. One of the recommendations I can make, should you be thinking about buying now or in the next couple of years, is that be patient. Don't chase the market. You may want to shop the interest rate and see what's best for you. Talk to several lenders, not just one, and buy what they're selling you. Because the inventory is also going up these days, that means that you have more chance of negotiating. You may ask them for repairs. You may ask them to help with closing cost. You may ask them to reduce the price, because as the inventory may go up, they may be more negotiable. So that's why it's important that you work with an expert agent who can help you get these things. And then buy for the long haul. Don't buy for the short haul. If you are feeling overwhelmed on what to do or what not to do, or where the housing market is going and is it the right time for me to buy or not, direct message me and I'll be glad to help you answer any question or refer you to a smart agent in your area. And please watch this video. YouTube is recommending it just for you.